Hi everyone, welcome back to Finance, and in this video we're going to cover the performance of the fund as of February 2023. Here's our quick disclaimer, and then we jump to our topic. Our discussion points, we have the market update and we have the portfolio review section. So for the market update, we're going to cover interest rate and inflation, and then we have the major currencies and then the stock market performance. For the portfolio review, we have the performance for the month, dividend yield and trading results. We have the geographic and sector exposure, and lastly, we have the risk management. So for our quick market update, we have here the US interest rate and inflation. So the blue line is actually the policy rate of the US, and the dotted line is actually the inflation. So for the policy rate, we can clearly see here that there's an uptrend from last year's July. And in fact, if we're going to look at for the last month, that's around um, 4.5, and then that's another 25 basis points hike by the Fed to 4.75. What if you're going to look at the inflation here from the peak of 9% last July? That's a downtrend from that peak, now currently at 6.5%. So we all know the impact of this interest rate trajectory. When interest rates move up, bond yields go up as well, and that would push the bond prices to go down. Now, at the same time, the higher interest rate would translate to higher discount factor in terms of valuing or valuation of stocks or equities. So later you will see how this interest rate hike or this in general this trend um, hawkish trend of the Fed translate to the valuation in equities as we move to the major stock market performance. And at this portion here, we have the dollar bond or the dollar index. So if you're going to look at here, beginning this year, it was actually trading near 100, but now it's up uh, another 4 points. So that if we're going to look at that's currently trading at 104. Now this one is highly correlated to the interest rate. So the higher the interest rate of the US, the more that the dollar would strengthen. So this direction here of the Fed actually translate to this trajectory of the dollar bond index. So the higher the interest rate of a particular central bank, that's the stronger the currency would be. Okay, so for the Eurozone, you're looking at here again, the blue line is the policy rate and the dotted line is actually the inflation. So for the interest rate, it's pretty much the same with the US from 2.5. That's another 50 basis point hike by the ECB now at 3%. Or if you're going to look at the inflation from above 10%, it's 10.5 at least. It's now easing at 8.5, but again, uh, compared to the levels before COVID, this level is pretty high. So same with the US, we might be seeing high interest rate environment in the Eurozone, uh, maybe for the entire year. Okay, before we can experience dovish tone of the central bank. Now, uh, this trajectory again of the policy rate uh, would give the currency a bit of an upside. So if you're going to look at here from 2023, we can now see here a bit of an uptick from parity actually. Okay, so from this point, now it's at 106. For China, we have here the policy rate at slightly above 3%, and then we have the inflation at slightly above 2%. So if you're going to look at here, there's an uptick in inflation, so probably we might be seeing the central bank of China to move the interest rate as well to combat this uptick in inflation. But if you're going to look at their currency now, this is the USD versus CNY, and we have here weakening dollar at this start maybe last week of February and up to this day. If you're going to look at it moved from close to 7 to 6.8. But nevertheless, if you're going to look at start of the year from, I think this level here, it actually moved. Um, the currency actually depreciates, and as the dollar, King dollar again, um, bounced from 6.8 to near or above at least 6.5. Okay, in terms of the performance of the stock markets, the blue line here, we have the S&P 500. The proxy for that is the um, SPY. And then for the yellow one, we have here the FTSE. That's oh, I think this is the Euro stocks of 600. And then for China, we have the red line here. We have the FXI or China large cap. So if you're going to look at the performance of the SPY, it actually retraced from the peak in 2022. But if you're going to look at the level since COVID, it's still way up from that point. Now for the Euro stocks, this is the pre-COVID right here, and if you're going to look at it, it's still up uh, by at least 10, maybe 10, 20% from this point. But if you're going to look at the performance of China large cap from this point, and then it actually went to as high as this point in sometime in March 2021, and now it's still below the pre-COVID level. So if you're going to look at if there's uh, a chance for China to outperform or maybe perform this year, there's really a large potential, particularly for the large cap player. If you're going to look at here, it's way below its COVID bottom. So the moment that we can see the China will fully reopen its economy and could contain um, COVID infections and uh, open economy again to more business, then we will see this to breach the COVID bottom is now serving as the resistance, and then finally go back to the level where the pre-COVID is. Okay, so our second section or portion of the video is all about the portfolio performance. So here we have the SP 500 index currently at 4,000 level. And if we're going to look at the year-to-date performance, it's 5.37% compared to the performance of the portfolio that's around 2.47. So the portfolio is a bit underperforming compared to our benchmark. And then the dividend yield and trading results, our target is 10, but because of the retained cash level, it's down to 8.53%. But again, we're slowly allocating and defensively allocating the funds, so we can go back to as high as 10% annualized dividend yield. For our trading history, this is actually for the last 30 days, but the figures here that you see is actually good for 1 year. So we have here about 630 trades for the year, 89% profitability, and that's 2.55% realized gain. Okay, so that would translate to around nine. Okay, 9 out of 10 trades are profitable. So that's how you interpret that one. And for our geographic exposure and sector exposure as well, more than half of the assets of the portfolio is in the US, and then the rest are distributed to these regions. And for the sector breakdown, we have real estate, and then followed by the commercial cyclical. So we're again, this allocation to real estate is very important because of our objective, and that is to deliver high dividend of at least 10% a year, and then with monthly distribution. So We are also slowly loading up some tech or growth stocks as we see that the Fed may start to pivot from hawkish tone to dovish tone, maybe second half this year or last quarter this year. Um, Although we have the issue on recession, but I think some of the growth stock companies, particularly the large cap, are already pricing in those volatilities. So we have zero exposure to crypto. And then for our risk management here, we have an average of 4. That's pretty much 4 the rest of the year. But if you're going to look at the drawdown here, that's negative 3.75 for daily max, and for yearly, that's negative 20. So it's still within our target. Our target average risk score is 5, but now it's still below that level. And then for our portfolio risk overview, so if we're going to look at here, more than half of the assets are classified as low risks. And then we have a few in the risk region or risk assets classification that's at least 6%. Okay, so that's pretty much it for this video. Thank you again for tuning in. And if you like the video, please do like and then share. Also consider subscribing, and remember to follow us on eToro.